So, good morning, everybody.
Morning.
Sorry, good evening.
Evening.
It's morning here.
Good morning to you and good evening to all of us.
Yeah, yeah. The screen is visible, right?
Yeah, it's visible.
Yeah. So today we'll discuss the journey of Jana Small Finance Bank. So when I was working in NABARD, we used to finance this Jana Small Finance Bank. Like we were quite enthusiastic when these small finance banks were formed. We got some new clients who would take loan, and moreover, the purpose for which they were giving loans was. Matching with the ideology of NABARD. NABARD basically works for rural India. So we wanted MFIs and NBFCs, to take loan, but they were risky borrowers. So since these organizations turned into small finance banks, we found it relatively, safe to, give loans to them. So some kind of connect is there when it comes to GenSFP with the organization where I worked for over 40 years. So, yeah, can we start the discussion?
Sure, we can.
Yeah. So, ge- if we can briefly, so this is basically tries to depict from a small MFI. Now it has aspirations to become a universal bank. Let us see how its journey went through. So to introduce, initially in 2000, this there was this organization called Sanghamitra Rural Financial Services. It was a part of Myrada. Myrada is one of the very respected NGOs in the country. They have promoted a lot of NGOs, microfinance institutions during that time for rural India. So it started as MFI during that time, and they were serving the rural poor. Then what happened was they wanted to expand it, and in 2006 the Janlakshmi Financial Services was uh, incorporated as a separate entity away from Myrada. And the founder of this Janlakshmi Financial Services was one Mr. Ramnathan, and he's still on the board of Jana Small Finance Bank. So he and
नेहरू
his
भी
wife thought. Hmm?
कनेक्ट नहीं हो रहा है यार कनेक्ट नहीं हो
Any problem?
Hello, Mahesh ji.
मैम कंटिन्यू करें
कंटिन्यू कुछ प्रॉब्लम है
नहीं मैम बोल ओके
shall I get back?
Yeah, I would request everybody to kindly mute, please. Mahesh ji, please mute कर देंगे. Thank you.
So Janlakshmi Financial Services was founded by one Mr. Ramesh Ramnathan. He is an ex-employee of ICICI Bank, so I think you will be able to relate to him, I guess. Uh, uh, he was from ICICI Bank, and he and his wife, they started this Janlakshmi Financial Services. Basically, they wanted to serve the urban poor. They felt that the urban poor, there's nobody to actually serve the needs of these urban poor, and they thought that there was a lot of potential in that area. So the basic idea of starting Janlakshmi Financial Services was to serve the urban poor. So the over a period of time, they scaled up the business so much that they were serving about more than 5 million customers. And imagine each person was not taking loan which was more than 50,000. Like the loans were ranging between 15,000 and 50,000. So that is a kind of I mean, the transactions, if you can understand, they're quite huge, and they have to be in touch with these customers, because all these poor customers, unsecured loans they are giving. So unless they're having the uh, uh, touch with the customers, it will be difficult for them to get the recoveries. So this experience, basically from 2000 onwards, made them feel that, I mean, they were able to understand how the dynamics work when it comes to giving small loans to the poor. So in 2013, they have registered themselves as the NBFC MFI with the Reserve Bank of India. Then looking at the scale of business, like during that time, Janlakshmi Financial Services was one of the biggest MFI, and they were doing pretty well. They were winning a lot of awards for the kind of work they were doing. So in 2015, they got the in principle approval to become a small finance bank. So small finance bank, the difference between a MFI and a small finance bank is, once you get the tag of a bank, what happens is the regulations will be more. And but what happens is they will get access to the deposits which are low cost. So they will be able to, otherwise as an MFI they have to borrow from somebody and then give loans. And I mean, the price at which they give loans will be much higher. So once they become a bank, what happens is they will be able to take deposits from public, and then they will be able to lend at a lower rate of interest. So this way they will be able to tap the savings needs of the rural poor as well, since they are already their customers. So that is one of the biggest advantage they have. But the regulations were quite stringent. Like for a normal bank, the priority sector lending rules are only up to 40% of their deposits they are expected to give as priority sector lending. But when it comes to small finance banks, 75% of their loans, of their deposits, they have to serve for the rural poor. And yeah, this was one of the of course it was advantageous for them. But what happens is, when they give small loans, they will not be able to get big profits. So it will become very difficult to earn more profits and scale up their I mean, functions. So in 2015, but the basic idea of Reserve Bank of India was that these banks should get funds at a lower rate of interest, and they should be able to serve the rural poor or the urban poor, the underserved population. Basically they should be served with certain advantages of lower rate of interest, and banks interested in giving loans, and they wanted to wean them away from the money lenders. So that was a story about the small finance bank. So they got the in principle approval in 2015, and 2017 they got the license, and they basically commenced the operations in 2018. So this took a little time, because in 2016 the demonetization has come, and the bank suffered huge losses because of that. Because all MFIs, we know that they deal with the cash economy, and they went into a lot of trouble, and it took some time from them, like from 2015 to 18, that almost 3 years it took for them to commence the operations as a small finance bank. Then of course they have scaled up and stabilized their functions, and they have become a scheduled bank in 2019. So scheduled bank status, RBI generally gives only if they feel that the bank is capable enough to take care of the depositors interests. So that is a basic intention of including them in the second schedule. So the bank was able to give that confidence to the Reserve Bank of India, and in 2019, it became a scheduled bank. and in 2014, within 5 years, they got listed on the stock exchange. So one of the regulation for a small finance bank is, suppose the net worth uh, goes, I mean, like, not the net worth, the total assets, if they go beyond 500 crores, what happens is, they have to list on the stock exchange within 3 years. It is not the total assets, I mean, it's sorry, it is the net worth. If it crosses 500 crores, they have to list on the stock exchange within 3 years after crossing 500 crores. So then, in 2014, it was listed on the stock exchange, and now within 1 year, they have already applied for permission to transition into a universal bank. So the advantage of transitioning into universal bank we'll discuss a little later. So this is the progress of the Jan Lakshmi Financial Services. Then, having understood the history of the bank, we'll try to see what their financial parameters are. So first and foremost is, if we have to be a long-term investor in such a bank, like a bank which is promising, which has started as an MFI and has aspirations to become a universal bank, we can be little confident about their intentions and the direction in which it is moving. So this in case anybody is interested in investing in this bank on a long term basis, we have to first understand whether what kind of capital adequacy, and whether it is showing any signs of solvency or no. There are certain indicators for that. So let us discuss one by one. One is the capital CRAR ratio, the capital adequacy ratio. I hope everybody is aware of this particular norm. So for the normal banks, it is around 9%, but for small finance banks, it is 15%. They have little more stringent CRAR regulations, because basically CRAR is expected to take care of the unexpected losses. Expected losses, that is, during the course of their business, they are expected to understand what kind of loans they are giving and what kind of risks emerge out of those loans, and then they have to set aside some capital in the form of provisions. But what happens is, sometimes the bank has to face unexpected losses, and the CRAR, if they're the capital adequacy, I mean, the amount of capital which needs to be set aside, if they are able to maintain that, then the Reserve Bank of India, the regulator, will have the confidence that the bank will be able to be solvent in spite of certain exigencies which it might be able to face. So during 2018, the CRAR was almost 35%, which is quite high. Uh, then later on, what happened? I mean, basically, if you see the formula of CRAR, it is capital divided by risk-weighted assets. Risk-weighted assets means they constitute all the assets, like all the loans that are given, and the uh, investments that they make, and then the operational part of the bank. No, those all those things, all those risks are covered in the assets. So they have to set aside a certain portion of these assets towards the capital. So what happens is, suppose the numerator increases or the denominator decreases, the CRAR will be high. So if you have a CRAR of 35%, it indicates that either their equity is very high or the risky assets are very low. So in the initial years, they had good capital, and the risky assets also were quite low. That is the reason they were able to maintain a CRAR of 35%. Later on, in 2019, if we see, it has drastically declined to 18.81. It indicates that the assets have increased, or the bank might have faced some losses which has eaten up the I mean, the numerator, that is the capital. So then afterwards, the bank struggled to keep the CRAR ratio uh, yeah, at least conforming to the regulations of the bank, that is 15%. So in 2021, if we see, it is 15.5 and 15.3. Then in 2023 it is 15.6. So the bank has been facing some problem or the other. That initially it was demonetization that has affected, and there were a lot of NPS that we'll see a little later when we see when we discuss the asset quality of the bank. Then later on, all of us are aware, 2020, 21, 22, the banks, most of the banks suffered losses because of COVID. So all these things had a very brutally affected their capital of the bank. And we can see that the bank was somehow able to maintain the regulatory capital. Then again, you can see the improvement in 2024 and 2025. There is a little more improvement. So this tier 1 capital is a part of the capital adequacy ratio. There is a tier 1 capital and tier 2 capital. Tier 1 is supposed to be the core capital, which I mean, basically, it has no obligations to be repaid to anyone. That is the meaning of the core capital. So tier 2 again is also a core capital, but what happens is it basically consists of long term loans. Like it takes really maybe 20-year or 25-year kind of tenure those loans will have. They are also relatively stable with the banks. So they are treated as a tier 2 capital because they have the obligations to repay that loan. Tier 1 capital is the equity capital which stays with the owner, with the bank, and it doesn't, there's no obligation to repay that kind of capital. That's why it is called tier 1 capital. So this tier 1 capital, they are expected to maintain 7.5%. So after yeah, from the data is available from 2021, so they were able to maintain much higher tier 1 capital, that is as against 7.5, they were able to maintain about 11.8. So it only indicates that the tier 2 capital is much lesser. Then again, we have this debt equity ratio for banks. What happens is, uh, they, I mean, like initially when it was an MFI, it had to depend on borrowings to lend. But once it became an SFB, these resources will be supplemented by the deposits. So if they are able to garner a lot of deposits, there is no need for the bank to take loans to give, I mean, advances. So this is reflected in the debt equity ratio. Since the deposits have been going up, the debt to equity ratio has been reducing. So from 5.04, it has come down to less than 1% in 2025. So that is about the debt equity ratio. So the lesser the debt the bank has, the better it is for them. Then you have the leverage ratio. Leverage ratio basically tells that how much of exposures means how much of loans they are giving uh, relative to their capital. It is a simple ratio. So what happens is, during the global financial crisis that has happened, uh, many of the banks, they were able to maintain capital adequacy ratio of 9%, but there was no restriction on the amount of loans that they were giving. So they were giving loans which the rating agencies were rating them as AAA or the best of the loans. So there was no need to keep too much of capital. But what happened is, suddenly all these loans from AAA, they have been downgraded to D grade. That is the um, uh, I'm like you will not be able to recover those loans. So default grade, they were degraded. So what happens is, suddenly the capital requirements will increase phenomenally, and when that happened, many of the banks collapsed. That is the reason the internationally this leverage ratio was brought in, and they have given restrictions as to how many times their capital they can actually take exposures. So they cannot go beyond certain number of times. So here the ratio was fixed at 4%. So here again, the bank is quite comfortable, while the leverage ratio is 4%. That if it is 4%, it indicates that they can give 25 times the capital. So 100 divided by 4 basically. So here they have a lot of scope for increasing their loans. So the bank, and this has been increasing. So 6.65 in 23, then 10%, then again 10%. It's able to maintain. So the leverage ratio is quite comfortable. Then we have another ratio which tells the net NPA to net worth ratio. This, what happens is, if you understand the concept of NPAs, so you have the gross NPAs which are mm, uh, uh, where the default is more than 90 days. They have to categorize them as gross NPAs. Then what happens is they have to make some provisions against these gross NPAs. Then when you reduce the provisions, you get the net NPAs. So suppose this net NPAs, because we are taking care of certain portion of the gross NPAs, so the bank is safe to that extent. But the net NPAs, there is no provisioning. So suppose these net NPAs go bad, what happens is, how much of the net worth the bank will lose, that portion will be able to understand when we look at this ratio, NPAs divided by the net worth. So if you see in 2021, it was 55%, quite high by any standards. And there are certain benchmarks. If it is less than 5%, it is considered to be strong. But if it is more than 30%, it is highly vulnerable. Like the bank is vulnerable to go into liquidation. So when you look at the years in 2021 and 22, this ratio was 55% and 43%. Thereafter, uh, it has improved so well that now in 2025 they have reported only 3% of this ratio, which is considered to be quite good. So from a vulnerable status, it has become a strong bank. Then next is the book value per share. This has also been increasing consistently. In 5 years, it has almost doubled. So 193 to 392, it was able to scale up. So this is about the solvency. These are certain factors which indicate whether the bank will be able to withstand any kind of exigencies, and without going back into liquidity. Uh, do you have any questions on this? Anybody?
Hi, good evening. My name is Kamal, and I wanted to ask you, when you said the tier one funding
Yeah.
does not need to be paid back, what I understand is the rest of the funding. So let's say in 2025, the 80% is coming from deposits, and
Okay.
the others are coming from. That's what I want to know. Where is that 19.8 coming from, which doesn't need to be paid back? Who is
See,
funding that
deposits
component?
deposits will not be part of the tier one capital. Tier one capital is only the equity and the reserves which the banks maintain.
Who has
So
funded that 19.8%? That's what I want to know.
19.5%, we'll see the shareholding pattern in a little while. You will be able to understand. So the basically the promoters will be there, then public will be there, then foreigners also will be there. They will be able to, if they are subscribing to the equity of the company. So basically the funding comes from there. Yeah. Do I go ahead? Any other questions?
Thanks. Yes, you have answered the query.
Yeah.
Thank you.
Yeah. Thank you. So then we'll look at the net worth. We just discussed from where that money has come. Here you is the answer for you. So the additions during the, I mean, like the share capital in 2017, when it was mm, just given the license to become NBFC, the share capital was only 27. Now it has gone up to 105. So it's not great, phenomenal, because basically share capital either you get from I mean, the owners have to subscribe to the share capital. So if we look at the numbers, so every year there had been some addition or the other. So in 2017 and 18, later on we'll see the kind of losses the bank has incurred. So despite that, they have been private equity organizations who have trusted this bank, and they have invested from time to time. So, and that too, they have invested like with a lot of share premium, like the equity capital would cost say only 10 rupees, but they would have paid much higher. In certain cases the amount was more than 1300 for each share. So that money will go into this share premium reserve account. So if you see I mean, share premium reserve a little down, that is serial number 2B, the share premium is much higher. So this is the capital which the outsiders would invest for towards equity. So that towards equity they will take only 10 rupees, but the remaining amount, the premium which they are paying for purchasing the share capital, will go into the share premium reserve. So share premium reserve is also not repayable to the investors. But what happens is, and that is the reason why it can go as a core 1 capital, that is the tier 1 capital. It is treated as a core capital only. So if you see the additions in 2017, the share premium reserve was 994 crores, and uh, again there were additions which went up to 1622. Then of course in 2019, because of the losses, it has eaten up the share, I mean the net worth. So that's the reason it has come down, and later on again, um, this wherever additions are there, they were the new funds, new infusion of capital that has taken place. So it has happened till 2020. Then afterwards it has reduced a little. So in 2024 again, you can see a spike because they have gone for listing, and public has subscribed to their shares, and there was this capital infusion has happened. So you can see the reserves here, and the balance brought forward from P&L account indicates the losses that the bank has incurred, and these are all the accumulated losses which they are still carrying in their balance sheet. So this, what happens is, the total reserves plus capital, this is 7045 plus 105, which is supposed to be the net worth. This gets reduced to 3986, because the accumulated losses will have to be reduced from the capital to get the actual capital which the bank is holding. So the net worth will work out to 4091. So the bank, if you look at the this particular slide, you will understand that basically this serial number 4, where balance is brought forward from P&L account, these are the losses which the bank has incurred, and this is how it is eating up into the net worth that we can see. So from in 2019, the net worth reduced to 674 crores, but now it's a phenomenal improvement. It's almost 7x times it has increased to 4091 in 2025. Then next we come to the shareholding pattern. So basically the promoters of Jana Small Finance Bank is uh, Jana Holdings Limited, they call it. It is they are not financially very strong, but they have promoters promoted this particular organization. So initially, so when once you get listed on the bank, the promoters' shareholding is expected to come down, and especially if you want to become a universal bank, they have to reduce it to almost about 15%. So that is what you can see here. Once it got listed, the promoter shareholding has come down to 22.54. This will slowly has to they have to reduce it in I think a 5 years period they have given to 15%. So the promoters contribution is this much, and public shareholding is 40 almost 50%. And the foreign investors are around 28%. So this is how the shareholding pattern is. So now total number of shares which are there now is 11.51 crores. So initially, if you see in 2018, it was only the promoters. The promoters were not there. Public shareholding and foreign investors were there. Then now you can see that the graph, if you see the green one, basically tells the foreign investors are also taking interest. Of course, though the percentage has reduced because the Indian public are also investing in the bank. So if you look at the public shareholding, there are resident individuals who have invested about 27% in it. Then body corporates are there. They have invested around 11 point, almost 12% in it. Mutual funds have invested. Then qualified institutional buyers, they have invested around 5% in it. Then you have other alternative investment funds, then HUF, all these people. Then employees were also there. All these people are included in the public shareholding. Then you have foreign investors, you have foreign corporate bodies who have invested around 26.57%. Then you have foreign portfolio investors. They around 1% of them have invested in this, and non-resident Indians have invested around 0.3%. So this is the basically the shareholding pattern. Any doubts in this? Any questions? So TPG Asia, yeah, hello,
Yeah. I didn't see the chart where you had the shareholding pattern, where you were
yeah,
describing NRIs and other
yeah,
institutions that are holding shares.
yeah,
Do you have a slide for that one as well?
yeah. It's there, right? The current
Yeah, but this
slide,
one
which is
doesn't
there.
show like small companies or NRIs holding. Like you did mention to me, 0.3% was being held
Yeah,
by NRIs.
yeah,
Doesn't
yeah.
show it on this chart.
Yes, yes. Yeah, I have just I made it because if you want, I'll send that information to you.
All right, thank you.
Yeah. So basically, there's this organization called TPG and then GIC. They have been consistent investors in these in Jana Small Finance Bank from 2017. They have been investing in it, and whenever they suffered losses, they were the ones who were coming to the rescue of this bank, and they have reposed a lot of confidence in the organization. So, if we are done with the capital part, we can now get to the one second. Yeah, to the business parameters. So having understood the solvency part and how they are able to mobilize the capital being the most important part for any bank, we'll try to see how they are managing their business. So basically, the work of a bank is to borrow money and then lend it and then make a yield out of it. So the resources are basically through deposits and then through borrowings, and with this they are expected to do advances as well as some investments. So we'll try to see the major business parameters, that is the deposits. So in 2018, of course, it started off with 0.45 crores, and now if we see yeah, it's almost around 30,000 crores. The bank is able to mobilize deposits. The CAGR in the 7-year period, in the growth of deposits is around 38%. So that is quite a quite a growth we can say for deposits. They were able to garner so much of deposits. So but the only problem here is, since it is a new bank and it requires a lot of confidence of the depositors. They were not able to attract low cost deposits. The CASA deposit share, if you see, it has only 18%. When you look at the other commercial banks, it is over 40%, normally the CASA ratio. This particular bank, of course, it was the CASA ratio is only 18%. So basically, CASA ratio will, if it is higher, it only indicates that they are able to mobilize low cost funds and they will be able to lend at a lower rate of interest. So the cost of funds basically will get higher if the term deposits are more. So then we can look at the deposits. We can see that from 7,600 crores, it has come down to almost around 4,000 crores in the last 7 years. So as the deposits increase, the dependence on borrowings will come down, and naturally these things will come down. So advances portfolio basically, in the last 7 years, advances growth was at the rate of 24% per annum. That is the CAGR. And year-wise, if we see, there's a lot of fluctuation. Initially in 2019, because they suffered a lot of losses, they were cautious about the kind of business they would do. The growth was only 3%. Then it spiked in 2020. Then again, it came down in 21 and 22. These two are the COVID years. Then in 23 onwards, you can see certain improvement. Then again in 25, the growth has fallen to 17%. So basically, in 2025, one of the main reason for the degrowth is there are certain problems in the MFI sector, and which are there for quite some time. So those are some of the reasons why they were not able to add. The growth in advances was not that good, but still 17% is much better than the industry average of 11% during this year. So, and one more important thing to be noted in advances is the bank has consciously, like, it has burnt its fingers quite badly. The kind of losses they suffered during 2019, it made them cautious, and they have consciously worked to increase the secured loans. From unsecured loans, they have tried to shift to the secured loan. So uh, it was the secured portion of the loans was only 15%, and now it has gone up to 70%. So they were consistently working on it, and year after year, if you see from 15 to 25, then 43%, then 54%, then of course now it is 70%. The bank actually aims to give 80% of their loans, they wanted them to be secured loans. So out of this 30%, which is unsecured loans, those are also the bank was telling that almost 3/4 of those loans are covered through some guarantee scheme of the government or the other. But anyways, secured portion is 70%. So when they have more of secured loans, what happens is there are two effects to the increase in the secured loans. Secured loans, since they offer security, they cannot give at a high, I mean, rate of interest. They cannot lend at a high rate of interest. The interest rate, the earnings will come down to that extent. But what happens is they'll have savings when it comes to the risk weighted assets. The capital to be maintained on secured loans will be lesser, so they will be able to maintain a better CRAR when you have a secured loan portfolio. But only thing, the earnings to that extent will come down. So the bank should be able to balance these two factors to stay profitable. So that is about the advances. Then you have the cost of funds from 11.6%. The bank was able to reduce it to 8%. So it is slightly higher from 2023, which was 7%. Now it has increased to 8.1%. So you can see also the CASA portion of the deposits has come down from 20% to 18%. That could be one of the reasons why the cost of funds has increased. Then the total assets, it clocked a CAGR of 22% in the last 7 years. Total assets from around 10,000 crores, they have almost increased 4x to 38,000 crores. So year on year growth of the total assets is also given here. Then if you look at the deposits to the total resources basically consist of deposits and then the borrowings. So the share of deposits, if you can see, it has increased from 51% in 2019 to 88% in 2025. That is also one of the good features of the business parameters. So any questions on this?
One more question. I'm
Yeah.
new to this banking field, so it may sound
Yeah.
very small question to you, but for me, it's a genuine question, which is what percentage of secured loans become NPAs, and what percentage of unsecured loans become NPAs? Do you have any table or data on that one?
See, as an Abadian, no, I have little bias when I want to answer this question. So you have to forgive me for that, because yeah, we have seen microfinance loans for quite some time. NABARD was the one who started this SG movement in the country. Then we promoted all these banks to encourage them to give in refinance. Basically, we used to give for their microfinance portfolio for these banks. So what we found was, in the initial years, of course, microfinance sector has seen lots of ups and downs. Uh, so basically, if you are able to give those group lendings, the recovery percentage was as high as 99%. But over a period of time, things are changing. So now it's simple. Common sense tells that if it is secure, people will be careful enough to get their securities back. They will repay the loans. And if it is unsecured, then they might mm, they may not repay the loans. So it depends upon bank to bank how they are managing and how secured these loans are. Like housing loans are there, so they are expected to be secure. So if the portfolio of housing loans increase, then the security is good. But again, you have seen the global financial crisis basically happened because of housing loans. So yeah, I don't know how I can actually answer this question. Basically, it depends upon the bank how it is managing these loans. So we'll try to see what kind of loans this bank is giving. In the next slide, we'll be seeing that.
All right, thank you.
Yeah. So this is just a graphical presentation of what we have discussed earlier. So here, if you see the housing, affordable housing, from 7% in 2021, it has increased to 21%. Then uh, microfinance loans against the property, that has also from 10% they have increased to 20%. MSME loans, they have been relatively stable, the percentage to the total loans. Then of course the term loans to NBFCs are also almost at the same range. Then other secured loans, these include these gold loans and other loans, like maybe loans against FD and things like that. So they have also seen some kind of improvement. Basically, they have concentrated on housing and then micro LAP loans. Then other secured loans, I think the two-wheeler loans and the four-wheelers, tractors and all, those are also included in other secured loans. This portfolio, they are consciously trying to increase. So yeah, this is a portfolio of the loans which the bank has. Any questions on this? So having understood the advances, let us see the asset quality, how they are able to maintain. Asset quality, basically, it shows how much of prudence they are having when they are giving loans. So if they are able to assess the ability of the borrower to repay the loans, the asset quality will be good. And if they are not able to assess, then you can expect the asset quality to go bad. So the gross NPAs in 2018, they have spiked quite a lot to 3,183 crores. Then, of course, they tried to contain them. Then they have reduced to 749 crores in 2025. So in 2018, whatever was the NPAs, those resulted in heavy losses for the bank, and the accumulated losses are still there in their books. It might take quite some time for them to wipe out those the accumulated losses. Then, of course, you have the net NPAs, which were 16,071. Now they have reduced considerably to 254 crores. And they have, in fact, in 2024, it was a better picture of around 130. Then, because of the microfinance crisis, probably they have increased to 254 in the current year. So the ratios also, gross NPA ratios were 42% and net NPA 28% in 2018, that they were able to reduce to 2.5% and 0.9%. So this is a lot of improvement. You can understand that the bank has burnt its fingers, then afterwards they have made concerted efforts to ensure that the asset quality of the book uh, improved, and it improved phenomenally. That's what we can see from the figures. Then slippage ratio tells you how much of the new loans during that particular year the bank has actually incurred. I mean, like how many loans have become NPAs during that particular year. So if we look at the gross NPAs and net NPAs, they include the loans which were given during earlier years also, which went bad. This slippage ratio tells you how much percentage of the loans which became NPA during that particular year. So this is basically are the fresh NPAs. So in 2018, if you see, almost half of their loans have gone bad. So this has considerably reduced to 4%, and of course now in 2025 they have increased slightly to 6%. Then the provision coverage ratio, ideally it should be around 70%. So the bank has been able to increase its provision coverage ratio to yeah, in 2024 it increased to 74%. Now it has slightly reduced. Then of course this accumulated losses we have discussed earlier. Then these are the technical and the prudential write-offs. Like what happens is this they simply remove from the balance sheet. So they were able to improve their loan book because of these write-offs. But what happens is they are the one-time losses which the bank incurs. So that mm, that portion of it is given here. Yeah. So now, if we see the write-offs are almost less than 1% now. So from 4% in 2022, they have reduced to 1%. So this is the quality of the loan book. So any questions on this? So I mean, no
Any
doubt.
reason why
Yeah.
we are accumulated losses, why we are continuing to carry forward? Why are we not writing them off?
See, basically, accumulated losses, they have to wipe it out from the profits. So they are not able to earn that kind of profits to remove the accumulated losses. That is the reason why it is getting reduced from the net worth. So if you have to calculate this capital adequacy ratio, it cannot carry accumulated losses. So without accumulated losses, the net worth would be much higher. Since they are reducing the accumulated losses from the net worth, uh, the net worth is showing much lesser. So basically, these losses they should earn and then remove the losses, right? They
Right.
cannot. Yeah. So that is the reason why it is still showing in the balance sheet. Anything else?
Ma'am, any idea on how much would be the net interest margins that they would be earning? Because the cost of funds are around 8%.
Yeah.
So,
So we'll see that also. There's a slide on that.
okay, sure.
So this is the income analysis, how much of income they are earning and what is the expenditure and how they are able to get the net worth, net profit that we'll see here. So the gross income, it has clocked around 19% CAGR in the last 7 years. So from 1600 crores, it went up to 486 crores. So that is a gross income, which includes interest from the interest income as well as non-interest income. So for the services, they would have earned some money that also goes into this. That is a gross income. So the growth, if we see in the during 2025, it went up by 17%. Then you have the expenses. Basically, the banks have three types of expenses. One is interest expenses, since they are taking deposits at a price. Then they have certain borrowings. Those interest payments will be there. Then operating expenses will be there for carrying out the business. Then of course the loan loss provisions are there. Those are basically three type of expenses the banks incur. So we try to analyze how and they are faring in this kind of thing. So operating expenses, they grew at a CAGR of 4% in the last 7 years. So from I mean, like we can say that they were relatively, like initially they were quite high. Then now they are able to maintain at around between 35 to I mean 30 to 35%. That's what we can see. In the last 5 years, from 38 it has come down to 35%. So they were able to maintain the operational expenses under check. Then interest expenses, they increased at the rate of 10%. uh, and they almost form around 40% of the total gross income is taken away by the interest expenses. So if they are able to like increase their CASA deposits. And if you see their NCDs and other things which they float for debt instruments, it almost costs them some 13 to 14% when they go to market to raise resources. So that is why a reason why these interest expenses are much higher. So that I think the bank has to reduce. So from 73%, of course, they have reduced it to 42%. This here, I think it requires further scope for reduction. Then loan loss expenses, of course, from 4,000 crores. Uh, no, from Yeah, provisions from 14, almost 1,500 crores, it has come down to 725. In fact, last year it was only 524 crores. These provisions they were able to do well because they have improved the asset quality very well. So from 93%, and it was 100% in 2019, they were able to reduce it to 11% and 13% the last 2 years. So total expenses, if we see, they are able to get a net profit, a very small percentage of the net profit. So in 2023, the expenses almost formed 93% of the total gross income. Then there was some improvement in 24. Then again in 25, it has spiked by 5%. So the net profit, if we see from the losses, the last 3 years, it was able to. In fact, last 5 years, it was able to show profits, net profit they were able to show. Otherwise, in 2018 and 19, they have incurred losses. Then they posted net profit from 2020. So from 30 crores, it has improved to 501 crores. This also actually could have been higher. Around 300 crores they have set aside for provisions, anticipating, like they were not required as per the NPA norms, but sensing that there is a problem in the MFI sector, they have set aside some 300 crores. So those are accelerated provisions, what they call it. So if that they added, the profit percentage would have gone up. It was almost around more than 800 crores in the current year. So this is the income analysis. Any questions on this? So these are some of the business ratios. The returns indicate broadly how the business is faring. So last 5 years, they have given the data. Return on equity has increased from 7.5% to almost 13%. Return on assets from 0.5% to 1.49%. Net interest margin here, you can see uh, they are able to get around 8%. So this is despite it only indicates that they are giving loans at a higher rate of interest. So if their cost of funds is around 8%, and if they're getting a net interest margin of 8%, so around 16% to 17%, they must be lending.
That's right.
Yeah. So debt equity ratio, we have discussed this earlier. Then provision coverage ratio also we discussed. This is the earnings per share. So in 2025, it is showing 47.89. That is because of the accelerated provisions which they have set aside. Some 3,305 crores they have set aside. So in case those assets don't go bad, probably in 2007 6, apart from the profits that they have earned during 2026, this 300 crores also will get added to it, and there will be a good spike in the profits in the next 2026. So yeah, any doubts in this? So basically, I hope you all understood how the bank is functioning. So it had very bad years in 2018-19. Then it made a lot of efforts to improve its functioning. Quite ambitious they were. A few strategies they have undertaken to increase the secured portion of the loans, then reduce the NPS to a certain extent, and improve their financial parameters. And there was continuous equity infusion at regular intervals. Whenever they had problem, they were having people to invest in the bank to ensure that the bank remained solvent. Like it was able to maintain a 15% CRAR ratio all through, even during their difficult times. These are some of the conclusions we can make from the figures. Then, of course, external ratings, if we see, uh, there are three rating agencies who have rated their instruments, their debt instruments: India Ratings, Care Ratings, and ICRA Limited, and all of them have given A stable. So if we look at the ratings, like in ICRA in 2018 and 19, the rating was triple B negative. So triple B is basically investment grade, the lowest investment grade it is, and it has given a negative rating in 2018 as well as in 19. Things started improving from 2024 23 onwards. In 23, they have given a triple B stable. Then that was in March 2023, and in September 23, it has upgraded to triple B positive. So in between 23 and 25, the ratings, they could improve from triple B to A. That means after triple B, you have again double B, then B, then triple, then of course A. So this also, I mean, triple A is the best. It has still some way to go to reach that particular level, but nevertheless, from being a triple B negative in 2019, the bank was able to uh, get a good improve its ratings to A stable. So, why did the rating agencies? What are few considerations which they have taken? Is one is their capital profile, because they were continuously getting capital infusion and they were able to augment capital. That was one of the reasons why the improvement has taken place. Then the asset quality and earning profile has improved quite a bit from compared to 2019. So that is one more reason, and steady increase in the share of secured loans, that was another reason. And then they were able to diversify their portfolio also. So from just giving microfinance loans, they have uh, tried to give loans to other various other sectors as well. So that is they have been improving in that particular aspect over a period of time. Then yeah. Of course, the concerns which they have is they are still not able to garner low cost deposits. They're still relying on the term deposits. So that is one of the concerns they have. Then apart from that, what happens is they have these two holding companies, Jana Holding Limited and another JCL is there. So when they infused capital, mm, they actually raised NCDs in the market and they infused capital in Jana SFB. Then afterwards, the repayment, the founder organizations are not strong enough to repay on their own. So those repayments had to be made by the Jana Small Finance Bank. So there again, the old private equity funds, which were always coming to their rescue, they were the ones who have refinanced those entities. So in so that is one, either you can treat it as a minus point or a plus point. So they went into trouble and they were always somebody there to rescue them. whenever they had issues. So that is about this, the rating agencies. Then another important thing is, if the bank has to do well, basically it has to find opportunities where it can do business. So here you can see the picture. They were able to, basically it is a bank which was established in, its headquarters are still in Bangalore, but it could spread into many areas. So the 25th state they added last year, that is in Andhra Pradesh. So they were able to expand quite well in the last 7 years. They have around 802 banking outlets. Then yeah, ATM network, of course, is very small. Of course, in the normal banks are removing the ATM, so there's no point in increasing the ATM network, because now card based payments and all those things are there. Then yeah, they have good rural centers. Around 32% of their outlets are in rural centers. Then earlier, these business correspondent model was there. That is actually showing a lot of reduction. When I was in NABARD, we were promoting these model quite a lot for the rural banks, to utilize the services of BCs where they are not able to actually reach the customers. So this bank has also um, uh, I'm like tapped this particular source to give their loans, and they are showing reduction in that. So in from 9% around 10% in 2024, they've almost reduced to 5%. So this, they are reducing the dependence on the business correspondent model, because they are increasing their banking outlets, so they don't actually need the BCs. uh, and they have their own staff to take care of the banking business. Then so they have also indicated that over 12 million customers they have served since 2008. That's quite a number. Then active customers as of now are 4.2 million. Then the employees are over 25,000. So since these people have to be in constant touch with the borrowers because they give micro loans, they require more employees, despite uh, being tech savvy. So yeah, they have you can fairly tell that they have a good national presence, and rural presence is also good. Then yeah, good customer base, and then the employees are also quite good. So this is about their footprints. Then you have this how much tech savvy they are. This particular slide, you can see. So basically, that Mr. Ramanathan, who is the founder of Janalakshmi Financial Services, from the beginning he understood that if they have to serve so many people, and they have to give such small loans, they have to reduce the costs, and that is possible only through technology. So they emphasized quite a lot on building technology from the beginning. So as of now, if we see mobile banking, uh, they are able to I mean do quite a lot. Year on year, last year I think they have 19% growth is there. Then volumes are also up by 64%. Then so they are able to penetrate quite well through these particular thing. And the bank has a top rated banking app. So they also have an app, and they do business through the app. Then So 98% of their transactions are digital, and 99% of the loans are processed digitally. 99% of the sales force use tab or mobile. So these are certain indications that how tech savvy they are. Then UPI transactions, they are able to do up to, I mean, the increase was around 82%, so quite a good jump. Then yeah, they are able to engage the customer with the customers through cards. So 87% of the customers have cards. Then out of that, 72% have active cards. So only thing is, when it comes to digitalization, the improvements and the changes are happening quite rapidly, and they have to keep pace with that. That is the main issue. So any questions on this? Then another important factor which we have to actually see is whether the board is good or no. Because if the governance is good, we can expect the bank to be good. So here you can see Ramesh Ramanathan. He is still the non-executive, non-independent director. So they have all experienced and well qualified people on the board. So this slide indicates that. So next comes their aspiration to become the universal bank. So universal bank, basically the main advantages are like you don't have to do 75% towards priority sector lending. That is one of the main advantages. Of course, the regulations will be much tighter, but still they'll have the flexibility to give loans, then to large borrowers as well. Then of course not just lending, they will be able to do many other functions like investment banking. They'll be able to do, they can open subsidiaries and expand however they like the example we see State Bank of India, how it is, and ICICI Bank. All these are universal banks. So they have forayed into so many sectors, and there's no stopping for them to actually do relative cross selling and all these things. They will be able to do when they actually become a universal bank. So these aspirations, so there are certain norms for becoming a universal bank. One is the net worth should be more than or 1000. So the net worth of Jana as on 31st March, if we see, it is more than a little above 4000 crores. Then it should have worked as a bank at least for 5 years, satisfactory track record. The bank is in existence for the last 7 years. Then profit in the last 2 years, it should be showing net profits. So last 2 years, the net profit figures are there. So in 2024 it was 669, and this year around 500 crores. And asset quality, gross NPA should not be more than 3%, and net NPA is less than 1%. So there also the bank is eligible, because they were able to contain the gross NPAs less than 3%. It's around 2.5%, and NPA is also less than 1%. Capital adequacy norms, 15%, they should be able to meet. The bank has sufficiently higher CRAR of 20%. Then it should be a scheduled bank. Then it should have been listed on the exchange. Then of course the promoters should be there. Governance part, there are a lot of regulations relating to that. So the board continues to be there, and quite an efficient board, we can say. So these are certain things that make this bank eligible for being a universal bank. But we have to see whether the Reserve Bank of India will give the permission or no. So they have applied only in June 2025. So these are some of the advantages and opportunities. So rating agencies, of course, they are maintaining a stable outlook. They should be able to continue to do that, because the bank has better aspirations. Then transparency is good, because they are on the exchange, so their activities are relatively transparent. then they will be able to increase their products, and this will in turn help in increasing the revenue. Then lower cost of funds, because it's a universal bank, more trust on them, so they can expect the CASA to go up, and the deposits growth also will be much higher. Then loan composition, as I told you, from 75%, it can the priority sector lending can be reduced to 40%. So this is one very big advantage which the bank will get once they become universal bank. Then they can scale up, and the network also can be expanded. um, since they are early, like there are 11 SFBs, I guess, in the country, and this will be the third SFB which has applied for universal banking. Of course, AU SFB is one, then Ujjivan is one, and this will be the third one who has applied for universal banking. So, since they have taken this step early, so it will have a competitive differentiation when it comes to other banks, other small finance banks. Then, of course, risks are there. Strong competition. They have to compete with the likes of SBI, and then ICICI Bank, HDFC, and all that. Then they should be able to raise capital, and how they are going to up the scale in other parameters that we need to see. Asset quality risks. If they should be able to manage to give better loans. Then operational efficiency. So since they will be foraying into various other fields, how they're going to manage those things, that we need to see. Then regulatory oversight will increase, and compliances will be much more. Margin pressure will be there. Now they are able to get around 8% NIM, so that will reduce, because if we look at the other banks, you don't expect to get a net interest margin of 8%. Hardly some 3% to 4% is considered to be very good when it comes to other banks. Then, of course, cost management is one they have to check. So if we compare with AU and then Ujjivan, these are some of the data which is there. AU is far ahead when it comes to all parameters. So the current market price, Jana SFB is around 480. Then AU is 764. Price earning ratio, of course, is quite good, 11.7. Uh, then market cap 56,980 for AUSB, and this is only 5,000 crores. So there it has to scale up quite a lot. Then return on capital employed is almost same when it comes to all the three banks. Then net profit also, AU Financial, I mean SFB, almost 5x higher. Revenue also, similar figures are there. So the best, of course, is the AUSFB. Jana, if we look at the way they are working, it should be able to gain grounds. And then Ujjivan is better than Jana, but of course it is suffering a lot of GNPS during the present crisis. No, has pulled the bank down. So we can discuss Ujjivan sometime. Mm. So this is about the peer comparison. Any questions? Any discussions on this?
I think a very detailed presentation, ma'am. I mean, it's given a very good understanding of how the journey of the bank has been, and how it has moved on all the parameters. So,
Yeah.
I think the only challenge for them will be a CASA ratio, because now even you see the large banks are also struggling
Yes.
with
Because people are not interested in investing, depositing in the banks. Now
yeah,
they are
people are not
running after
interested
the
in,
exchange.
absolutely.
Yeah.
So keeping money in
In
current
those
account and
banks,
saving accounts, people are not interested. So
yeah.
because a lot of money is now flowing towards the equity markets and mutual funds. So I think
Very
that will
true.
be one big challenge for them. But otherwise, I think they've done a very good job in terms of NPAs and getting their act right in terms of the asset mix, etc.
Exactly. Yes. That's true.
We have
So
anybody has any other questions?
Can we have this one as a video on YouTube as usual? This is for Pratham.
Pardon me, I didn't get.
Usually, Pratham will put this up as a video on YouTube. So if we go
This
back,
I think recording is there, so it should
yes,
be able. Yeah.
yes, that would be great.
Yes. Yes.
Yes,
Sure.
it's quite good. It's a very good in-depth thing that we have and that we can go back and listen to again to study more
Yes.
about how banks actually perform on the inside.
Yeah.
And it's very rare to get an insight into a bank. Thank you very
Yes.
much, Sujatha ji.
Welcome. You're welcome. It was pleasure talking about Jana Small Finance Bank. Yeah. So we can conclude, is it today?
Yeah. Anybody else has any other questions? So I think we can conclude, ma'am. Thank you so much.
Yeah. Thanks a lot.
It was a pleasure listening to you. Thank you.
Thank you.
Appreciate your time. Thank you and good night.
Yeah. Good night.
Thank you. Bye.
Thank you so much, ma'am.
Thank you.
Yeah, I'll see you.
Yeah. Bye.